Hello, everyone, and welcome back to the Everyday English Bite. In our last episode, we learned the basics of the stock market and what it means to own a share of a single company. But what if you don't want to pick just one company? Or what if you want to invest in something you can't physically hold, like the future price of oil or gold? Today, we're moving to the next level of investing. We're going to explore funds, ETFs, and the complex, sometimes dangerous world of derivatives, like futures contracts. We will learn how they are made, how they work, and most importantly, how risky they really are. But first, let's warm up our brains with today's key vocabulary. Pay close attention to these three words, as they are the foundation of advanced investing. Number 1, derivative. A derivative is a complex financial contract. It doesn't have any value by itself. Instead, its value is derived or taken from the performance of something else, like a stock, a currency, or a commodity. Example 1. The billionaire lost a lot of money trading complex derivatives during the financial crisis. Example 2. A futures contract is one of the most common types of financial derivatives. Number 2. Underlying asset. The underlying asset is the actual, real thing that gives a derivative its value. If you have a derivative contract based on the price of gold, then gold is the underlying asset. Example 1. If the price of the underlying asset drops, the value of your derivative contract will also drop. Example 2. Oil, wheat, and stock market indexes are very common underlying assets. Number 3. Leverage. Leverage means using borrowed money to multiply your potential profits. It is like using a physical lever to lift a heavy object. You can control a massive investment with only a small amount of your own cash. Example 1. Using high leverage in the stock market can make you rich quickly, but it can also wipe out your entire bank account. Example 2. The real estate investor used the bank's money as leverage to buy 3 apartment buildings. Great! Now, let's dive into the fascinating world beyond simple stocks. Let's start with the safest and most popular options, funds and ETFs. Picking the perfect stock is extremely difficult and risky. If you put all your money into one tech company and it fails, you lose everything. To solve this, financial institutions created the mutual fund. Think of a mutual fund as a giant shopping basket. Millions of investors put their money into this basket. Then, a professional fund manager uses that giant pool of money to buy hundreds of different stocks or bonds. If one company in the basket fails, the others can balance it out. You're buying a slice of the whole basket. Then, the financial world upgraded this idea and created the ETF, an exchange-traded fund. An ETF is also a basket of stocks, but unlike a mutual fund, an ETF trades on the stock market exactly like a regular stock. You can buy and sell an ETF in 1 second on your phone, and the fees are usually much lower. Today, ETFs are the most popular way for normal people to invest safely. Their risk level is generally medium to low, depending on what is inside the basket. Now, let's step into the more complex world of derivatives. Remember our vocabulary. A derivative is a contract based on an underlying asset. The most famous type of derivative is a futures contract. How is it created? A futures contract is a legally binding agreement to buy or sell something at a specific price on a specific date in the future. Why was this created? It was actually created for farmers. Imagine you are a corn farmer. You plant your corn in the spring, but you don't know what the price will be in the autumn. If the price crashes, you go bankrupt. So you make a futures contract with a cereal factory. You agree today to sell them your corn in 6 months for $5 a bushel, no matter what happens. The farmer removes their risk, and the factory locks in their price. However, today, most people trading futures are not farmers or cereal factories. They are just financial traders who are guessing which way the price will go. If you think the price of oil will go up next month, you buy a futures contract. If the price goes up, you sell the contract to someone else and make a huge profit without ever actually touching a barrel of oil. This brings us to the risk level. Derivatives and futures are extremely high risk. Why? Because of leverage. When you trade futures, the financial institution doesn't ask you for the full amount of money. To control $100,000 worth of oil, they might only ask you for a $5,000 deposit. If the price of oil goes up just 5%, you double your money. But if the price drops by 5%, your entire $5,000 deposit is completely destroyed. You can even lose more money than you initially invested. To summarize, ETFs and funds are baskets created by financial companies to help you spread your risk safely. Derivatives and futures are complex contracts that let you bet on the future price of almost anything. They are powerful tools, but because of leverage, they should only be handled by professionals or very experienced investors. We covered some very intense financial concepts today. Let's wrap up with 3 common English idioms related to risk and investing. I will explain the meaning and the context together, followed by 2 examples. Number 1, hedge your bets. In gambling, if you bet on both teams to win, you are hedging. In finance and daily life, this means protecting yourself against loss by supporting more than one possible result or having a backup plan. Farmers use futures contracts to hedge their bets against bad weather. We use this idiom whenever someone makes a safe secondary choice just in case their main plan fails. Example 1. She's applying to a local college to hedge her bets just in case she isn't accepted into Harvard. Example 2. Smart investors hedge their bets by owning both high-risk stocks and safe government bonds. Number 2. A double-edged sword. A sword with 2 sharp edges can cut your enemy, but if you swing it wrong, it can easily cut you too. We use this idiom to describe a situation, a tool, or a strategy that has both a very positive effect and a very negative or dangerous effect. In investing, leverage is the perfect example of a double-edged sword. Example 1. The new artificial intelligence technology is a double-edged sword for our company. It saves time, but it might replace jobs. Example 2. Fame is often a double-edged sword because you get money, but you lose all your privacy. Number 3. Skin in the game. If you have skin in the game, it means you have personally invested your own money, time, or risk into a project or a company. You will suffer if it fails. We use this idiom to show that someone is truly committed. For example, investors trust a CEO much more if the CEO has invested their own money into the company's stock. They have skin in the game. Example 1. I don't trust the financial advisor's recommendation because he doesn't have any skin in the game. Example 2. If we want the employees to care about the project's success, we need to give them some skin in the game, like a profit bonus. And that is our bite for today. You now know the difference between an ETF and a mutual fund, what an underlying asset is, and why leverage is a double-edged sword. Review today's vocabulary and try to use hedge your bets in your English conversations this week. Thank you for listening to the Everyday English Bite, and I will see you in the next episode. Stay smart and invest safely.